Sure, we had two big topics then, Albert. You're right. It was at the end of July. We were both in Vancouver for a very large natural resource conference. And what I said at the time, I basically gave a warning, a forecast of a war with North Korea, a preventive war started by the United States against North Korea to disable, dismantle their nuclear weapons and intercontinental ballistic missile programs, and also to decapitate the regime and precipitate regime change in North Korea. Since then, everything I've done, everything I've learned has confirmed that forecast. I would say that we can box it fairly narrowly. These are things that will happen before the end of March. I based that on some meetings I had in Washington. I'm on the board of a foundation that hosted a small private meeting with Mike Pompeo, the director of Central Intelligence Agency, and General H.R. McMaster, the National Security Advisor to President Trump. And interestingly, Albert, after I left you in July, I kept working on this problem. It's one of the most challenging problems I've ever worked on. And throughout the month of August and September, everything I was seeing confirmed my thesis, in particular a series of missile launches over Japan. I mean, I don't know if you know, but school children in Japan, they have, and adults for that matter, they all have cell phones just like everyone else. And I'm sure on your own cell phone, I know on mine, you get these push alerts, sometimes a tornado warning or a brush fire warning or whatever. Well, people in Hokkaido, in the northern island of Japan, got a warning, a duck and cover. There's a North Korean missile coming. And there was. It flew right over Japanese territory. Now it went out into the Pacific Ocean, but there's no assurance that it wasn't heading for Hokkaido when it first launched. There's no assurance that it doesn't break up and fall in parts. So, you know, you got to put yourself in the shoes of these people where they're getting duck and cover warnings about North Korean missiles. Then on September 3rd, North Korea detonated an H-bomb, a hydrogen bomb, which of course is a different, far more powerful technology than an atomic bomb. Atomic bomb is a fission weapon. An H-bomb is a fusion weapon. We don't have to get into all the physics of that, but suffice to say it's exponentially more powerful than anything North Korea has. So they were moving very quickly down this path of ICBMs, H-bombs, marrying the two technologies, building, say, an arsenal of let's say 10 to 15 of these H-bomb tipped ICBMs, which could basically destroy American civilization in a matter of hours. You know, people talk about our anti-missile technology. It's pretty good. It's the best in the world, but it's not better than a 50% kill ratio, meaning if North Korea launched 10 missiles, at best we could shoot down 5, probably 3, which means we would lose, let's say, you know, Los Angeles, Seattle, San Diego, Denver, Chicago. This would obviously cause a significant societal, social breakdown in the U.S. and probably lead to martial law just as a way of dealing with the damage. So that's what we're facing. And but then I went around to a lot of experts, particularly in early October. I reached out to CIA assets, other people with other connections to the intelligence community, people who were looking at satellite imagery, et cetera. And what I heard from them was, yeah, it's too bad, but they got us, in the words of Steve Bannon, that the costs of launching a preventive attack on North Korea were simply too high, that this could involve a nuclear weapon in Seoul, Korea, nuclear weapons at Japan, and it was too bad we didn't do something 5 years ago or 10 years ago, but we were just going to have to contain North Korea, use deterrence to bottle them up, use sanctions, diplomacy to try to get them to stand down. But the bottom line was that it was too late to do anything about it militarily. So I walked into my meeting with Pompeo and McMaster prepared to say, yeah, the war's not coming because the costs are too high, based on what I was hearing from these other experts. I heard the exact opposite from the two people closest to the president. I mean, Pompeo's in the Oval Office every morning. President Trump takes his what's called the PDF, PDB, rather, President's Daily Brief from Pompeo personally. In the past, the CIA has sent what they call a briefer over to the White House, but President was hearing from Pompeo directly, so he's in the Oval Office every day. McMaster, you know, is 2 doors down the hall in the West Wing. That's who I was hearing from. Pompeo said it would be imprudent to assume that it will take North Korea more than 5 months to get this capability to pose an existential threat to the United States. So this was on October 20th. So that's when I pegged the outside date for the war on March 20th. And then McMaster said, and these were the key words, he said acceptance is unacceptable, meaning acceptance of North Korea as a nuclear armed power is an unacceptable posture for the United States. So here are the two people closest to the president telling me we got a few months to get this to solve this problem, and we are not going to allow North Korea to have these weapons. So that means we're on the path to war, unless one of two other things happens. One is that Kim Jong-un stands down. He just says, okay, you got me. I'm willing to disarm and just continue my programs, do that verifiably, and let inspectors in. There is zero evidence that he's doing that, by the way. It's a possibility. I give it a 10% probability, but there's zero evidence that that's actually happening. The other path is assassination and regime change. And that's what President Trump was talking to President Xi Jinping in Beijing a few weeks ago during his visit to China. And there, it was interesting in the meeting I attended with Mike Pompeo. Someone asked him, why don't we just assassinate Kim Jong-un and get this over with? And of course, we all know assassination is illegal, particularly by the CIA. They used to do things like that, and that's made illegal. And Pompeo knows that. And his exact answer to the question was, I'm not going to answer that. And then he paused, and then he said, because if an unfortunate accident should befall the man, I would not want my words to be misconstrued. I mean, it was like talking to John Gotti, or the Godfather. So the point is, yeah, we are working on that, and I heard that from other CIA sources as well. So putting all that together, I would give a 10% probability to Kim Jong-un standing down, a 20% probability to a successful assassination and regime change effort, a 70% probability to war, and a 0% probability that the U.S. is going to accept a nuclear armed North Korea. So putting all that together, looks like we're heading for war, and it's not priced into markets. I'm not saying that people should run out and take all their money out of the bank and sell all their stocks. I'm just saying that that's a pretty big geopolitical risk that is not priced in the markets. Well, yes, we should be paying attention. Well, we should be doing both is the answer. Your question, there's a lot of name calling going back and forth between, Trump calls Kim Jong-un Little Rocket Man, and Kim Jong-un has some, pretty derogatory things to say about President Trump. And should we look at that, or should we look at, intelligence and more substantive things? The answer is we should look at both. One of the problems, and I met with the director of strategic studies program at Tsinghua University in Beijing. So really, they're leading think tank on national security issues. Someone who does brief senior Chinese leadership. I met with her in Washington a few weeks ago, about a month and a half ago, and she said to me that Beijing believes the United States is bluffing, and it was the whole scenario I outlined for you, Albert, at the beginning of this interview, that China believes this is just posturing by the United States and that we're bluffing. I said, well, we're not bluffing, and you go back to Beijing and tell them that, because this is on a path to war. But by the way, there has been a slowdown since September in the operational tempo of the North Korean weapons testing. It's not clear exactly why, but they did have that implosion and tunnel collapse, several hundred workers killed at their nuclear testing site. Some experts believe this is what's called mountain fatigue. They've used the same underground bunkers in the same mountain for a number of nuclear tests. So if you do that enough, you're going to implode the mountain as a whole. By the way, that's a threat to China, because even if it was just a man-made natural disaster, if you want to put it that way, that mountain collapses, that's going to release a huge amount of radiation from all the prior tests. Right now it's bottled up inside the mountain, but that could release a radioactive cloud, which based on prevailing winds would mostly fall on China. But at a minimum, several hundred workers were buried under these collapsing tunnels. That may have slowed down their nuclear testing, the detonations. It shouldn't, in theory, slow down the missile testing, unless they're trying to develop a warhead to put on the missile. And there's pretty good intelligence coming out of Japan, signals intelligence, that North Korea is getting ready for another missile launch literally in the next couple of days. As we speak, we might expect this missile launch as early as December 1st. So North Korea is still going down the path. So I would say don't discard the rhetoric, but pay attention to the intelligence also. We're still on this path I described. China is tightening the sanctions on North Korea. They're to kind of appease the United States to fend off a trade war and a currency war with the U.S., which is another whole issue. I mean, if it becomes clear that we have to go to war with North Korea and China hasn't helped us prevent it, why should Trump refrain from launching a trade war with China, which is what Robert Lighthizer, the U.S. Trade Representative, and Wilbur Ross, Secretary of Commerce, Peter Navarro, White House Counsel on Trade, all three of them are super trade hawks. They've been kept on a short leash because we're hoping China helps us with North Korea. But if they don't, or if their help is of no use because we have the war anyway, there's no reason not to go into the trade war with China, which I also expect. So, yeah, all these factors are relevant. It was a little surprising. These things are. I like going to horse races. I like betting on horses, and sometimes you make a bet, and the horse breaks its leg and out of the gate. I was expecting Warsh. It turned out to be Powell. The good news, well, it was good news, but it's just the case that Powell actually makes it easier to analyze Federal Reserve policy because Powell will do exactly what Yellen was doing. So, Albert, I've had a Fed model all along. It's worked extremely well. When we met in July, I said the Fed was done for the year, and indeed they did not raise interest rates in September, which is what I told viewers at the end of July. But it's also my view that they're not going to raise rates in December. There's an FOMC meeting, Federal Open Market Committee meeting, part of the Federal Reserve function, the rate policy setting committee that meets on December 13th. My forecast as of now is that they're not going to raise rates. Now, that's way, way out of consensus. The market consensus is close to 100% that they will raise rates. But I based my July forecast of no hike in September or December on disinflation. And that disinflation has not gone away. In fact, it's actually gotten worse since we spoke in July. The most recent data for September and October is at 1.3%. That the 1.3% inflation using the Fed's preferred metric, which is PCE deflator, core year over year. A little bit geeky, but that's of all the measures of inflation, CPI, PPI, trim mean, core, non-core, PC, etc. PCE core year over year is the one that the Fed uses. They tell us that their target is 2%. Last January, it was 1.9%. Actually, December 2016, it was 1.9%. It has been down or flat 9 months in a row. When we spoke, it was at 1.4%. Today, it's at 1.3%, still moving in the wrong direction. Now, there's another release coming out, 8:30 a.m., Thursday, November 30th, so literally a day or so away from when we're doing this interview. Let's see what it is. My expectation is that it will be weak, but regardless, it's certainly the case that if that comes in 1.3% or lower, it's hard to imagine the Fed raising rates on December 13th. They're just failing to meet part of the dual mandate. Now, if it's 1.6% or higher, that's hot. That would tend to validate Yellen's thesis that the disinflation is transitory, and that would green light a rate hike on December 13th. So if I see 1.6, I'll throw in the towel. I'll join the consensus, maybe. But for now, I'm standing by my model, and I do expect a weak number, and I do not expect a rate hike in December. But having said that, there are two other huge hurdles that Janet Yellen has to clear before she can raise rates in December. The second one is this tax cut. The Senate's voting Friday, December 1st on this tax cut. Let's see what happens. Right now, the market's expecting that that's going to pass. It's already passed the House. By the way, I'm using the word tax cut. It's really not a tax cut. It's a tax cut for corporations and some rich people. It's not a tax cut for me, by the way. I live in Connecticut, so I'm getting hammered with this taking away the state and local tax deduction. I'm not whining about it, but I'm just making the point that for a lot of people, this is not a tax cut. But be that as it may, whatever you call a tax reform, this is a really lousy bill. And I don't say that because of my personal situation. I say it because it doesn't provide incentives for consumption and investment and the kinds of things that the Trump people are talking about. But be that as it may, the market expects it will be stimulative, and the market has priced it in. But they need 50 votes. Right now, they don't have 50 votes. There are 53 Republican senators. Of course, there'll be no Democrats voting for it. There are 53 Republican senators. They can lose 3. There are 52 Republican senators. They can lose 2 and still win with a 50-50 tie and a tiebreaker by Mike Pence. But if they lose 3, this bill fails. Well, two senators have already come out against it, Ron Johnson, and there was another senator last night, and there were at least three other senators who could oppose it who have not spoken up yet, John McCain, Jeff Flake, and Susan Collins. So let's see how it all plays out, but this thing could crash and burn on Friday, and that would immediately, because it might be around midnight, but watch what happens to stocks on Monday at the open. They could collapse because they priced in a tax cut. If the tax cut fails, look out below for the stock market. And then that's another reason Yellen can't raise rates, because a disorderly decline in the stock market is one of the reasons why they won't. Third hurdle, December 8th, don't forget we have a government shutdown. Now, I'm not saying the government will shut down. I'm saying right now it is scheduled to shut down. The government spending authority expires on Friday, December 8th. Will the Congress patch it together and come up with another continuing resolution? They might, but think of the issues that are on the table. Financial bailout for Obamacare, funding for Trump's wall, DACA, the so-called Dreamer immigration fix. There are many, many other things, funding for Planned Parenthood, et cetera. It's hard to see how all this gets compromised, and Trump has punted on the wall twice in March and September. Pardon me, the only reason he went along with the delay in September was because they needed the disaster relief for Hurricane Harvey, Irma, and Maria. So Trump said no member of Congress, nor the White House, wanted to shut down the government at a time when we were in the middle of disaster recovery in several major cities. But that's behind us. I mean, they're still cleaning up in Houston, but the disaster phase is over. But so now you don't have that incentive for Trump to play along with the Congress. And also the budget, the Treasury's borrowing authority expires on December 8th. Now, they can use what they call extraordinary measures, shuck and jive a little bit and, dip into some funds and, in extremis, they can reprice gold. There are a lot of things they can do to keep paying the bills. But technically it expires. All this uncertainty, can you imagine the Fed raising rates when the government shut down? I can. I mean, that's really pouring salt on the wound. So Yellen's got to clear three hurdles. She needs a hot inflation number on Thursday. She needs a Senate passing the tax bill on Friday, and she needs no government shutdown a week from Friday. If you gave each one of those a 33% probability of failing, so say 2/3 chance they work out, 1/3 chance they don't, a 33% chance of failure on three discrete events is a 99% chance of failure. So this is why I don't think she's going to raise rates. But, let's maybe she'll pull a trifecta. Let's see how it plays out. I worked with, when Jay Powell was at the Treasury, and I was general counsel, one of the primary dealers who were the underwriters of the U.S. government securities market. We interacted a number of times. And my impression of Jay is the same as everybody's impression. Everybody likes Jay Powell, and that's rare in Washington to have someone who's well-liked by Republicans and Democrats. So I think that's a plus. He's a smart guy. He's a good guy. But as you correctly point out, he's a lawyer, and I actually consider being a lawyer rather than a PhD economist to be a plus, because lawyers tend to be very pragmatic. PhD economists tend to be more ideological, and they're wedded to obsolete models, and they get a lot of things wrong. So I like all those things about Jay Powell. Having said that, I think he's just going to follow the Yellen and Bernanke playbook. The case for Warsh, and I agree that he was probably a little too outspoken. See, Warsh is very independent. So if you pick Warsh, you're going to get an independent chairman of the Fed. That's not what the White House wanted. They wanted somebody, what the elites call a safe pair of hands, somebody who would come in and do exactly what they want, exactly what they expect. So Warsh and Powell are both lawyers, but Warsh is sort of an independent thinker, and Powell is going to, I think, go along with the Yellen playbook. So in a new financial crisis, I would expect him to do exactly what Janet Yellen would have done, which is first you don't raise rates. Then you cut rates back to zero. They could cut rates 4 times or at 25 basis points each and get back to zero. And then you go to QE4. Stop the right now they're not just tapering new asset purchases. That was over in 2014. What they're doing now is reducing the balance sheet. They are tightening the money supply. They are reducing base money. My view of the economy is very weak. Do you really raise rates and reduce base money when the economy is weak? Well, no, except that they have to get ready for the next recession. They're playing catch up. Like, why on earth are they reducing the balance sheet, which is a form of tightening, and raising interest rates, which is a form of tightening, putting a double whammy on the economy when the economy is struggling and has not regained trend growth? Well, the answer is that they should have done all this in 2010, 2011, not expanded the balance sheet as much, raised rates, normalized things back then when the economy could bear it. Bernanke missed an entire cycle, and now the Fed's playing catch up. They're desperate to normalize rates, normalize the balance sheet before the next recession. But the problem, of course, is, how can you normalize rates and balance sheet before the next recession without causing the recession you're preparing to cure? The answer is you can't. They're gonna mess this up, in which case it's back to, at best, a recession, at worst, a financial crisis. And Powell, I don't look for him to be that innovative. I would look for him to just basically run the Bernanke-Yellen playbook, which is cut rates and go to QE4. Well, this is a result of 9 years of central bank manipulation. I mean, the central bank, the Federal Reserve in particular, gave up its customary role. I mean, the Federal Reserve should only do two things: price stability, and they should be a lender of last resort in a crisis. That's all they should do. The idea that the Federal Reserve can stimulate the economy or create jobs, that's all nonsense. I mean, that's not what central banks do. They pretend that they do. They talk about it. Wall Street talks about it ad nauseum. But we have not had a return to trend growth in 8 years, despite $4 trillion of money printing by the Fed. And we have not had the inflation that a lot of people expected because of the absence of velocity, which is a psychological phenomenon. It has nothing to do with money supply. Moreover, the weakness in the economy is a structural problem. You cannot solve a structural problem with a monetary solution. You need a structural solution. So for all these reasons, the Fed is essentially impotent, but everyone wants to pretend they're omnipotent. But the point is, going forward, there's no question that the base case for the Fed is 4 interest rate hikes a year, 25 basis points at a time, every March, June, September, December, like clockwork, until they get up to around 3.25%, sometimes in late, say 2019. That's the base case. That's what they're trying to do. So why do I say that they're not going to raise rates in December when I just said that their base case is to raise rates 4 times a year, including December? The answer is there are 3 pause factors. There are 3 reasons why the Fed would not raise rates, despite the base case of trying to raise them 4 times a year. The 3 pause factors are disorderly stock market decline, job creation, below 75,000 a month. Ignore September because that was hurricane related, but below 75,000 a month. And the third one is disinflation, moving away from their inflation target. Well, that's the one that's operative right now. By the way, 2 of them might be operative. If the Senate doesn't pass the tax bill on Friday, you might see a disorderly decline in the stock market. So 2 of them would be operative, which is disorderly markets and disinflation. But one's enough. And again, if you get a weak PC number on Thursday, 1.2, 1.1, or even lower, I mean, that's going to put a nail in the coffin of the rate hike. So you have the base case, you have the 3 pause factors, and then as an analyst, you say, well, are any of the pause factors operative? If not, then they're going to raise rates as I described. If yes, then they won't raise rates. And so that's, but what's interesting, Albert, is that you have some very, very interesting, what I call asymmetric trades. An asymmetric trade is heads I win, tails I don't lose, meaning if you put the trade on, and for example, there are many of them, the euro, gold, yen, treasury notes, all of them are priced for a rate hike. Right now, gold's been kind of weak, the euro's been going nowhere, yen's been weak, dollar's been strong, yields are up, bond prices are down. All those things are based on an expectation that the Fed will hike rates in December. If the Fed hikes rates in December, nothing happens because the market's already priced for all those things. You're going to need some other events, some other news to get the market moving one way or the other. But if the Fed doesn't hike rates, which is what I expect, the market's going to have to reprice violently. All of a sudden, gold's going to soar, yields are going to crash, notes are going to soar, euro's going to go back to over 120, gold's going to be way over 1,300, the yen's going to be under 110, yield to maturity and 10-year treasury notes going to be 2.1. All those things are going to violently reprice. So you have a nice set of trades where if you put them on, and if I'm wrong and the Fed hikes, you don't lose much because they're already priced. But if I'm right and the Fed doesn't hike, you could have some huge gains.
You say I know all about it, but of course no one does. And why? And the reason is when they repealed Glass-Steagall, they removed the ability, they created the ability for these new mega banks to gamble. And that's what they do now. They don't lend to industry, to manufacturers. The kind of ways they used to make money are gone, and they basically are gambling, and they are creating all kinds of derivative instruments, the consequences of which I don't think are well understood. And as for the stocks, the equity markets, they're all highly inflated by the policies of these central banks in creating so much money. You know, it's not just the United States that was doing quantitative easing. It's currently Japan, the European Central Bank, the Bank of England. So you see all the four large components of world money, the Japanese yen, the euro, the British pound, the US dollar. They've all been created in enormous quantities. And in order to do that, or the way they've done that, is these central banks print money and buy up financial assets, bonds, but also stocks. You know, the Japanese central bank actually purchases equity shares as well. I believe that the Federal Reserve does that. Anytime the market starts to break, I think they run in and purchase S&P futures to stop the market from falling. So they all now have these massive trading desks. They can intervene in any market, not just bonds. And so you have these very low interest rates because they've purchased all of these debt instruments. So the interest rates are so low, the banks do all kinds of arbitrage based on the fact they can borrow money at essentially zero interest rates. And so you have this whole accumulation of financial values based on money creation. So trying to examine the equity market in any sort of traditional way, you can't do it. It doesn't make any sense. They're very high PE ratios, and we have also many corporations borrow money, which they can borrow at such low rates, to buy their own stock. And so that pushes up the stock, and therefore the executives and the boards can cash in on their stock options. And so it's all sort of a short-term thing, making lots of money in the short term at the expense of essentially destroying the companies. You know, it makes no sense for a company to incur debt to buy back its own stock. And it doesn't make any sense to create money for a decade and inflate all the financial markets. Because the reason the Dow Jones is so high is because of all the money that's been created. So that doesn't allow you to have a very good idea of what's going on. It's all been done deliberately in order to save a few big banks. But they've probably already made all these bad bets. You know, they do arbitrage on everything. You know, they're derivatives on currencies, derivatives on essentially everything. Student loans, car loans, truck loans. I mean, it's endless. And because when the banks busted a decade ago, you remember when we had the financial bust, they didn't punish the banks. They didn't correct the mistake of repealing Glass-Steagall, because Dodd-Frank or Frank-Dodd, whatever, it didn't do much. It doesn't really. What it tries to do is to substitute higher capital requirements such that the banks have more reserves to fall back on to cover their own bad bets. But I think the derivative bets are far beyond the ability of a bank's capital reserves to cover. And of course, the banks, they like this leverage. That's where their money is coming from. I don't know how long it's been since the large banks actually did banking instead of gambling. So it's a very dicey situation, and so I think it was correct to call attention to it. I think so, yes, because it's not based on reality. It's based on massive liquidity, and so it's full of all kinds of dangers. Yeah, what happens if there's a correction? Then some of these derivatives come unwound. You know, think back to the crash in, when was it, 07, 08?
Yeah.
No one had any understanding of the vulnerability. You might remember there was a book written and a movie made, and there were really only three guys who were outside the system who could see that the whole thing was phony. And
the Big Short. The Big Short, I think
money on what they knew was going to be a coming collapse.
The Big Short, I think you're talking about.
The Big Short, yeah. I mean, this is
Dr. Michael Burry.
Yeah. Well, the entirety of the financial system, except for, this tiny handful of people who were not actually participants in it, had a hard time even finding a way to take advantage of their knowledge that it was unstable. No one knew. They had no idea this was coming. And if you just look at AIG, they had one guy doing one thing, another guy doing the other, and the combination of it, no one understood, was totally destructive for AIG. And so I think it's still that way. I don't think anything has changed. The bailout did not cause the banks to change their behavior. And Frank Dodd simply said, you got to have more capital. But you can't, a bank can't look, what was the size of the bailout? I've heard things like $14 trillion. Well, there's no way the banks are going to have capital reserves of $14 trillion. So it's very dicey. I mean, the only reason people are in the stock market is they see the liquidity is flowing. And the minute the liquidity ceases, that is, if the Fed actually were to stop providing money, and the European Central Bank and the Japanese Central Bank and the Bank of England, and you didn't have all this money coming out, the equity values would collapse. So it's just a very, very dicey situation, and the Fed and the other central banks have let it go on for a decade, and the legislators haven't done anything about restoring Glass-Steagall, which separates commercial from investment banking. There's no separation anymore, and investment banking today essentially is gambling. So, yeah, I think the situation is probably worse than they said.
You think it's more than 9 banks?
If they gave their real concerns, they'd be afraid to do that because of some impact it might have. So I don't think it's understood. I don't think people understand what the situation is, but it does seem to be dependent on a continual provision of central bank liquidity. Well, I think it's what the hedge fund guy said who quit, which is what I say. Nobody understands the situation. And so many of the profits are phony. They're dependent on the cheap money, the cheap interest rates, the availability of liquidity. They are dependent on firms using their profits or going into debt to buy back their own shares. That keeps the market up. Where do the company's profits come from? Basically from laying off people, from jobs offshoring. If you dismiss your American workforce and send the work to China or India, your labor costs drop, your profits go up. But these are not profits from an expanding market. These are not profits from rising consumer incomes, from the workforce your own workforce doing well. And so they're profits that are created by destroying the domestic power of consumers. They simply lose their manufacturing jobs, they lose their IT jobs, their software engineering jobs, and they have to find some other kind of work which is paid less. So the U.S. market isn't there, and so the profits for the firms aren't coming from the growth of the domestic American market. It's come from cutting labor costs by moving wages offshore. Well, this can work in the short run for the firms, but in the long run, it destroys their ability to be profitable. The domestic U.S. market, retail sales are not growing. They're not booming. The jobs that are available and are reported at the monthly job reports are, for the most part, lowly paid domestic service type work, increasingly part-time. So how then can you have a stock market, record after record, when the domestic consumer power of the population isn't growing? You can't. So, yeah, people look and say, what is this? How can this be? Now, money managers are really just competing against their peers. So as long as they're all doing the same thing, and they have a good standing relative to their peers, they are successful. So they all stay in the game. No one knows what to do. Look, if this hedge fund manager doesn't know what to do.
That's right, Hugh Henry.
Yeah, he doesn't know what to do. No one knows what to do. And so what most money managers are doing is watching the Fed very closely. And as long as the Fed is not going to curtail the growth of liquidity, they're staying in the market because it's going to rise. So this is why there's so much attention. Oh my gosh, is the Fed going to raise the interest rates? Now, of course, if they do raise it, it's such a small amount that it's not really an increase. I think, Greg, that they've only raised the rates 75 basis points over all these years.
Yeah.
That's 3/4 of 1%. Well, during all these years, the inflation has been far higher than that. So they haven't raised interest rates in real terms. Actually, the real interest rate is falling.
Wow.
Because even with their low measures of inflation, it's higher than 75 basis points since the Fed started its interest rate increase policy a few years ago. So there's been no rise in real interest rates. And in fact, we have negative interest rates in real terms. And the Fed's afraid to do anything about it. And I think it's because the minute you don't have the liquidity to pour into the market, it's untenable. It's at a level that cannot be justified on a real basis. As I said, the sources of profits largely are moving labor costs offshore. And the high stock price is due to firms buying their own stock back and to the introduction of a constant stream of liquidity by the central banks. They're not due to strong consumer demand, rising retail sales, rising real incomes of the workforce. Those are the normal things that drove stock profits. They're not there to drive it. And so it's artificial. But if you're a money manager and you say, well, I'm not going to be in the stock market because it's dangerous, and you pull out, but the stock market keeps rising for the reasons we've discussed, then you lose all your customers. They all move to somebody else. So all these money managers are in the market, and that's where they'll stay. Now, it's very difficult to be in the market if you know anything as an individual, but it's a mistake not to have been in it this last decade because it's gone up dramatically. And there's huge paper profits in the capital gains. So it's one of those situations where you have to know you're at extreme risk, but as long as the policy continues, it's going to continue to be profitable for you. So I think that's really what's going on. And I agree that how does the Fed unwind this? You know, and it's so bad in Japan, for example, that they don't hide the fact that they also buy, the central bank, the Japanese central bank, also purchases stocks, equities. So, you're not supposed to have a central bank buying your stock market. It's clearly propped up. The whole thing is propped up. So you have everything propped up. What are the consequences for ordinary people? Well, retirees who expected to have interest income to supplement the Social Security. A retiree doesn't really want to be in the stock market because if you have a big adjustment, you can never recover. You may not live long enough to recover. So you've got all these people with no return on their life savings. You get nothing from CDs or bonds. So they're having to draw down their capital and live on their capital rather than the earnings on their savings. So this is disastrous because it eats up accumulated private wealth, and there's nothing for heirs. So, it's a really serious situation for the general economy, and I think it shows that the Federal Reserve, in fact, apparently any of these central banks, are really only there for a handful of big banks. That's all they're concerned with. All the Federal Reserve has been concerned with for the last, how long? Decade, easy, if not more, is the welfare of a handful of mega banks. And of course, the banks are too large. They should never have been allowed to get that large. When you have a bank too big to fail, then your policy has failed. You've allowed too much concentration. Where's antitrust? Where's the Sherman Act? Everything that was legislated in the past to prevent the kind of looming catastrophe that's hanging over our heads, as the IMF said, or was it the Bank of International Settlements or the IMF?
The Bank of IMF.
IMF. You see, this is a looming catastrophe. It's produced by the central banks.
Okay.
And they are perpetuating it because they don't know how to get out of it. They don't want to bring on the collapse. And yet there's nothing in the real economy to support these asset values. It's particularly true also of the bond prices. I mean, why do you have zero real interest rates when you have an enormous expansion of debt. The debt expansion is enormous. And there's no reflection of the risk of this debt in the interest rate. So the whole thing is just, it's an absurdity. But it will pay in equities as long as the money keeps coming out of the central banks. Well, there's no direct relation between that and the central banks putting out money. But if everybody is already completely nervous and, you know, just sitting on pins and needles, anything could cause them to flee. But there's no real reason for any war conflict to cause the central bank to change its policy. You know, look, we've been beating up countries now for, well, since Clinton attacked Serbia. We've destroyed and hauled apart in the last 17 years 7 or 8 countries in the Middle East. You know, those wars didn't cause any reduction in central bank liquidity. We're on the verge of trying to push ourselves into war with Russia. I mean, if anything should blow the market would be the prospect of nuclear Armageddon. But nothing has happened. We threaten. We don't just threaten North Korea. We threaten China. We threaten Russia. Anybody with the slightest intelligence can see that the United States is surrounding Russia with military bases, creating an environment among the population for war with all of the anti-Russian propaganda, all the false accusations and Russia-gate and all the rest. And most people understand that all this Korean thing is about is it gives Washington an opportunity to put nuclear missiles on China's border. And the Chinese know that. So all of these are highly dangerous things, and they haven't shaken the market. So I don't think anything, first of all, I don't think anything is going to happen in Korea.
Good.
The Chinese made it clear they simply will not tolerate it. The Russians have too. So, you know, unless the people in Washington are doubly insane, what this is really about is Trump trying to get the military security complex off his case. You know, they got on his case because he was going to normalize relations with Russia. Well, that was a threat to the budget and power of the military security complex. They've got to have an enemy. And so they started in on Trump, and he saw they were stronger than he is, and so he's turned into, you know, an aggressive war supporter. So he's talking tough about North Korea, and of course, Washington uses that to put missiles. They can tell China, oh, this is not directed toward you, it's directed toward North Korea. Just as we created the Iranian crisis so that we could tell Russia the missiles we're putting on their border has to do with Iran, not Russia. So it's mainly that, in my opinion, that's going on in Korea. I don't think that the Koreans will attack first. And China and Russia said that they will prevent any attack on Korea unless Korea strikes first. Then they're washing their hands up. So I don't think there's any chance of that being a war. It's mainly Trump showing how tough he is and getting the military security complex off his case because he's worried they're going to try to frame him up, you know, have Mueller. You know, we've still got this steady going, whether or not Russiagate is real. You know, we have this independent counsel, the former FBI guy. So on the whole, it's just not realistic that there's going to be any war there. But again, as we said, so what if there is? The question is, does the central bank stop the liquidity? There's no reason because of a war. You know, we've talked
obviously,
this many times. Let me say one last thing.
Okay, all right.
It seems to me that the only thing that would cause the Federal Reserve to stop the liquidity would be if the U.S. dollar fell under attack. If for some reason people decided, hey, we don't want the dollar anymore, and they started moving out of dollars into other currencies or into something else, it just ceased to hold assets in dollars. If that happened, the Fed would have to try to raise interest rates to support the dollar.
Wow.
And
so watch the dollar.
So then you could see, well, everything could come apart. If the interest rates go up, there's probably all kinds of derivatives that would not be, sustainable. The stock market would collapse. It would be a mess. It would be an utter mess. And that's what the IMF is worried about. It's a mess situation. How do you get out of it? And I think it's nonsense to pretend you can get out of it by building up the capital reserves of the banks. There's no way. So it looks to me like it's a situation they've got to keep going. They're going to keep it going as long as they can. Well, I don't think I would not be in debt, but Americans are, because how they maintain their living standard is to use their credit card. And you've got now, at least according to reports, of course, you never know about reports anymore because the media is so unreliable.
Yep.
Any kind of information that's trustworthy is hard to come by. But we now have reports that there are millions of Americans who can only pay the minimum payment on their credit card. Well, that means their debt is rising, even if they don't, buy anything. Because if you only pay the minimum payment, the interest, that's not enough to cover the monthly interest on your accumulated balance. So you get deeper and deeper in debt. And I think this is a terrible policy that they allow credit card companies to do that, where, okay, you can stay current as long as you pay this minimum payment. And the minimum payment doesn't cover the increase in the interest, the monthly interest charge. So you just go deeper and deeper and deeper in debt. Well, this sort of thing leaves people with no reserves at all. We've had these reports that hardly anybody in the country can raise $400 cash without selling personal possessions. I've written about this. We've probably talked about it in previous shows.
Yes.
Well, if you've got a population and they can't raise $400 cash, they've got no protection against anything going wrong. How would you suppose you were injured, or you are sick, or you're out of work, or you lose your job, or you got a mortgage, you got a car payment, you can't even raise $400. So, yep, being in debt makes this even worse, because we've learned too that unlike during the 30s, the policymakers are not concerned with individuals. Who went busted during the financial bust of 2007, 2008? The individuals, homeowners, not the banks. So, in other words, policy didn't save the homeowner, it saved the bank. And the banks that had made fraudulent mortgages, created derivatives and gambled on them, they all got bailed out. But the guy who lost his home, too bad for you, buddy. Well, in the 30s, it was different. The axe fell on the banks, and they tried to help people stay in their homes. So you can see the policy of the policymakers no longer is focused on helping the population. It's focused on, oh, the banks are too big to fail. And when you think about it, the New York Federal Reserve Bank, which is the bank that implements the Fed's policy, their directors are all the executives of the big banks in New York. And so that's whose interests they serve. So I think the IMF could have given a much stronger warning. And policymakers should step into this, bust up these banks, restore Glass-Steagall, prevent this concentration. But wherever you look in America, there's massive concentration. The media, 6 firms own 90% of the media.
Yeah.
This is an absurdity. This is against our whole tradition. It's against everything. It's against the Sherman Antitrust Act. We see, look at the concentration in digital information. You got Google. Look at Amazon, the concentration there. I mean, it's endless. We have now monopoly. It's pointless to talk about free markets. You've got monopoly, and you've got banking monopoly. You know, most of the banking is controlled by a few big banks. So we need reforms really more severe than occurred in the 30s.